guys, Brian Stevens here. I got Dave Stevens with me. We're going to talk about a couple issues that I think everyone's been thinking about lately. Let's find out what somebody in DC has to say about this. So how you doing again, Dave?
I'm good, Brian. Good to see you.
Okay, so the first one I want to tackle here is the role of brokers. As I booted up a moment ago, I heard you say in markets where it's busy, brokers tend to increase, and markets that are slowing down, brokers tend to retract. That's not the case right now. And there seems to be a new role, this kind of hybrid wholesale retail type of shop that's taking place with some of the larger wholesalers out there. What are your thoughts on that?
Well, look, I think you're right. This isn't sort of a classic wholesale channel structure. The reason why I once upon a time said brokers tend to contract, first of all, that was how the numbers looked in slower markets. And it's because they had to pay their own freight. You know, they had to pay their own way. They had to structure their own operations. I don't know how these new quasi wholesale, broker, retail teams are being structured, but there's no doubt that some of the big wholesale lenders are looking for a way to get some sort of sustainable relationship with a direct kind of retail production channel for them. Obviously, United Wholesale is the biggest in the country, and they've been the most competitive and aggressive in sort of protecting market share and space. If they're now venturing into helping to try to establish and support broker teams, you know, that might be a more sustainable way to protect kind of the broker model during slow times. But look, at the end of the day, it's all about capital. If you have to pay your entirely your own freight and you have overhead, it may get to a point for some brokers that they can't afford it. So unless they can walk into a system like this where they're being supported, helped, as it were, by some major wholesaler to help them stay in business, that's certainly one way to do it. And then the other way, of course, would be to just go be a retail originator for some other lender. Any number of things can happen. But yeah, historically, we've seen that brokers tend to contract in slower markets. You know, new structures like this could certainly be a game changer.
We had a conversation a couple of years ago where I don't think there was a huge appetite to discuss recap and release with the GSEs, the longest conservatorship in the history of our country.
Yeah.
Lucrative. I noticed that you were talking about this recently, and I wonder if there's a change of heart or what your thoughts are with the current situation with Fannie and Freddie and recap and release.
Yeah, I think the way I wrote a piece in Housing Wire about this, and I kind of laid it out as a lesser of evils. I really worry. I think we're at great risk right now. I think with it relates to Fannie and Freddie, we're at great peril that respective directors of the FHFA are going to begin using the GSEs as political tools, whether it's Mark Calabria from the Trump administration or Sandra Thompson from the Biden administration. What we're seeing now really troubles me. You know, I was very vocal on the LLPA changes, and I'm glad they pulled back on the 40 DTI, even though that was a really this bad judgment error to even put that out there. But, you know, their defense that the LLPAs are not a cross subsidy when in fact they clearly are is crazy to me. But it goes further than that, right? You have fees on 2-to-4s, on second homes, on limited cash out refis and cash out refis in general. All of these have been added in a new regime that says this isn't what the mission of Fannie Mae and Freddie Mac should be. In fact, I don't think it relates to risk at all. My guess is that if you were to risk model second home performance against like high LTV primary residence, the second home's going to perform better. And yet they're now charging fees for those loans. I think they become sort of political tools depending on who the administration is. And so in that sense, I think we'd be far better off as a nation and as a housing finance system to get Fannie and Freddie out from the conservatorship. They'd still be regulated by the FHFA, but the legal authority of a regulator only is much less than the legal authority of the conservator. And so if we were to find a way to get out of this conservatorship and get these companies released, that would clearly, I think, be a better outcome than what the tinkering that we're seeing right now going on with Fannie and Freddie. And Brian, just to be clear, they don't have the capital to be released. So that something would have to be done, whether it has to do with the warrants that the Treasury holds or some form of using the financing line that the Treasury has, backing the GSEs, converting that to some form of capital. There's a number of ways you could think about doing this, but at least in the current structure, I think we're in great peril as an industry. And you guys have had to deal with sort of death by a thousand cuts here because, you know, if they did it all at once, you'd be up in arms and, you know, parading down the streets of Washington, D.C. But first they take away a little bit on the 2-to-4 and the second home, and they tinker with this and they tinker with that. And you don't really feel the pain as much when in reality, it's really affecting what's going on in the marketplace. I'm about to publish another piece on the subject, so stay tuned.
It's a little kind of political jockeying, because as I looked at that, and everybody had an opinion with the LLPA changes, but when you started looking at some of the ones that benefited the most, the highest risk, highest LTV, the lowest credit score, highest LTV loans, they're not writing those loans anyways. You might as well go ahead, you might as well go ahead and say we're gonna chop out any loan level price adjustment. It doesn't matter. They're not writing those loans. So the only thing that affects,
it's interesting on that point. So there's a think tank in Washington called the Urban Institute, and they actually published a piece defending the LLPA changes. That's kind of what they do. They lean left, so they were out to defend Sandra and the team that made the decision. But yet they just published on their website. You can pull it up on the urban.org website. There's a housing finance policy center, and they have something called the monthly chart book. So they have the May chart book that's out with all the May data that was just fairly recently published. And if you scroll to the back of that, there's a page that shows best execution. So what's the better price? With the FHA MIP changes, anything below a 739 FICO with a low down payment is a better deal to go FHA than Freddie Fannie. Wow. Anything below 739. And so the point being that all of that jockeying in the LLPA grids was basically wiped out the moment FHA dropped the MIP. And they dropped it enough. Now, granted, a lot of realtors don't like FHA. FHA has different loan limits, so it may not cover every market. But in a general sense, if you're putting 5% down or less, you're going to get a better deal going FHA if your FICO is below 739. And remember, the LLPA changes only juiced the lower FICO band. So those cells that were improved are outside the range of getting a better deal by sticking with Fannie Freddie when you add mortgage PMI on top of it and LLPAs that still remain. To me, this is policy run amok. It's someone called it political malpractice to me the other day. Good. It's sort of arbitrary decision making in a vacuum. It's not really well coordinated with other agencies and isn't going to accomplish anything. And yet we're really screwing around with pricing grids at the GSEs. And again, not just the LLPAs, it's the second homes, it's the 2 to 4s, it's rental property, it's cash out refis, it's the whole 9 yards that are being impacted here. And guys, look, we're struggling to survive and homeowners are struggling to get a mortgage. This isn't a time to be allowing that stuff. So yeah, I think I've changed my view. I think Fannie and Freddie would be far safer to our real estate economy as a nation if they were not under conservatorship.
Sounds like your opinion has changed as the role of Fannie and Freddie and conservatorship has changed as well.
Yeah, absolutely.
So how would a cash window at Ginnie help lenders and help borrowers? I know that you wrote an article, which by the way is linked down below over on Housing Wow, so make sure we check it out. In fact, all of Dave's links are going to be down here, so just check them out. How would that help out lenders and how would that help out borrowers?
So first of all, that piece isn't written by me. It references me, but it's written by a guy named Scott Olson. He runs the Community Home Lenders Association, CHLA. He referenced a piece that I wrote on independent mortgage banks and kind of my frustration with the regulators focusing on them when banks are really the biggest risk in the country right now. But I've always said, and I completely support Scott. By the way, Scott Olson's a pretty big rock star in our world. He was Barney Frank's. If you remember Dodd-Frank, he was Barney Frank's housing guy when Dodd-Frank went through. So I first met Scott back in the day when I was being yelled at by Barney Frank, which is another story for another time. But the reality here is that what Scott is pointing out is there are government agencies that could provide sustainable liquidity to the mortgage system, particularly in support of independent mortgage bankers. I mean, we hear all these regulators talking about lack of capital and liquidity risk for community home lenders. I mean, Ginnie is in a really key spot, right? They could provide a cash window that would allow small sellers to not have to pool and create a Ginnie security that could literally theoretically sell a whole loan into Ginnie Mae and have it be pulled by Ginnie itself in kind of an ideal world. I also think, if you all remember the PTAP facility, that was a liquidity window that Ginnie has available that was going to be used during COVID when we were worried about liquidity for non-banks and having to provide advances and not have the liquidity to pay against those loans. Remember when we had all the forbearance in place? And that's a facility that's really, right now, the way it's structured is pretty obstructionist. It's very difficult to use. But Ginnie could be a facility for a variety of things. I really liked Scott's piece. I sent it to you today because I completely agree with Scott on the cash window piece. But that's only one step we could use the Federal Home Loan Banks, who are right now exclude non-banks. They only allow community banks and banks to be members. They're regulated by Sandra Thompson. They're federal agencies just like Fannie and Freddie are. Why do we keep that membership so closed when the Federal Home Loan Bank system could be have a swap window for IMBs to be able to swap assets for cash? It could be servicing. It could be loans that they hold on balance sheet that they could sell through a discount window of some sort. But the Federal Home Loan Bank system does this for banks. I'm not sure if you're aware of that, but the banks in America do all sorts of swaps with the Federal Home Loan Banks. I used to work for a bank. We did it all the time. We'd swap mortgage-backed securities in exchange for cash, and it would replenish our balance sheet to go out and lend some more. Right now it's a restrictive unit. So we have federal agencies that are here and not in use. And instead of complaining about the non-banks, when really they're the ones and brokers who are providing, frankly, the widest credit box, providing all the access for minorities and low-income buyers, frankly, right? 96% of all FHA loans are done by 93%, sorry, of all FHA loans are done by non-banks. The banks only do 6% of FHA mortgages. So rather than complain about independent mortgage bankers, let's use Ginnie and the Federal Home Loan Bank system to help bolster them, not to put greater risk, because all these loans are going into mortgages backed by the federal government. So they're not at risk at all. These are just short-term cash flow positions that can be offset. And that's just a role that can be played. I think Scott's piece is great. It was in Housing Wire yesterday. I'm glad you're posting it, Brian, and you can also pull it off the Housing Wire. But he's a good thought leader on this stuff, and I fully support his view in this one.
David, thank you so much.
You bet, Brian.